As you've learned by now, to be profitable purchasing a naked put at expiration, we need the stock price to move down in a rapid manner so that the put option is worth more than what we paid for it at expiration. Since you already know what a put option is, we'll use this section to talk about how long and short puts differ and uncover some of the option details that benefit the seller rather than the buyer. Everyone has a directional assumption with stock prices, and if you're purchasing a put, you definitely have a bearish one. In this example, I'm looking at buying a put at the 80 strike in the November expiration for $5. Since this option allows us to sell shares at the strike price, it has real value when the stock price is below the strike. In this example, we need the stock price to move from $80 to $75 to break even at expiration. If it is below $75, we would realize a profit as we paid $5 for the option, and it would be worth more than that if the stock was below $75 at expiration. If this makes sense, you already understand where the trade is profitable, where it loses money, and where the break-even is at expiration. Let's talk about setting up a long put trade and the pros and cons of being in the money or out of the money. When it comes to buying puts for profitability, out-of-the-money options have the lowest chance at success. The lower the strike is, the more the stock price has to move for the put to obtain real value. At-the-money options are closer to the stock price, but we end up paying more extrinsic value to purchase them since we're closer to the stock price. In-the-money options are the most expensive because they have intrinsic value, but they have a lower amount of extrinsic value than the at-the-money options, which means we don't need the stock to move down as much to be profitable at expiration. In this image, the large put all the way to the right might be made up of 90% intrinsic and 10% extrinsic value, but the puts to the left of the stock price are made up of 100% extrinsic value. Even though their purchase price is less, we need a movement in the stock price to make up for this, which is why the probability of success is low. As you learned in previous sections, high IV means high extrinsic value in option prices. That means that if IV is low, it is reflecting a low amount of extrinsic value in option prices. If I'm looking to purchase a put, low IV would mean a lower relative purchase price, regardless of whether that option is out of the money, at the money, or in the money. At the same time, this implies little movement in the stock price, so we shouldn't be surprised if we don't get the big move we're looking for at expiration. If $5 reflects a low IV environment, this same option might cost $10 in a high IV environment. This wouldn't be good for the buyer, as we'd now need the stock to move another $5 to the downside just to break even at expiration. Now that you've learned about some put contract details, let's talk about profitability. Stock prices cannot go below zero, so our max profit is capped at the stock price reaching $0 with a long put option. We can easily calculate max profit by taking our strike price, subtracting the debit paid for the option, and multiplying that value by 100. In this example, the max profit is $7,500 since my strike is at 80 and I paid $5 for the option. Since we're buying the option, our break-even is worse than the strike price. We pay extrinsic value to own the option, and that must be made up for at expiration by a bearish stock price movement. Our break-even is $75 in this example because we're paying $5 to buy the 80 strike put. As you can see, there are plenty of things working against the option owner, which is why we prefer to sell options rather than buy them. Let's take a look at the short side of a put contract and see how characteristics of the trade differ from the long side. At Tasty Live, we accept the fact that it's very hard to consistently pick the direction of a stock price, so we choose to trade in a way that allows us to make money even if we're directionally wrong. Going forward, realize that the short side of any contract is really just the opposite of the long side. If we needed the stock to move to $75 to break even in the long put example, that means we can allow the stock to move to $75 before we start losing money on the short side. We'll have all of these handy strategy cheat sheets available in the written section for your review, but let's break down each of these points individually to ensure you fully understand how these contracts work. When selling a put, we want the option to expire out of the money or reduce in value quickly so we can buy it back to secure a profit. This would happen fastest if the stock price rose higher, as that would slide our strike even further out of the money. As long as the stock price isn't below $45 in this example at expiration, we keep $5 in premium. Because our focus is maximizing extrinsic value relative to the risk we're taking, we're usually selling at the money or out of the money options. At the money options will have the highest extrinsic value, but closest proximity risk to the stock price. Out of the money options will offer less extrinsic value, but give us more space to be successful. Every trader will have a different preference with risk and reward, but we usually start at the 1 standard deviation range and adjust from there. That would equate to an in-the-money probability percentage of 16% or an 84% probability of expiring out of the money. Since options are cheaper in low IV environments, we want to sell puts in high IV. The higher the IV is, the more extrinsic value premium there is in the option prices, relatively speaking. This means a bigger credit for me as the seller and a better break-even price. If there was an increase in IV and no other changes in the market, that would mean that this $5 in premium has increased. If there was an IV contraction and no other changes, this $5 premium would have decreased. This is also why we prefer to sell premium in high IV environments. If IV contracts from that point, we may be able to close the trade for a quick profit. Max profit and max loss calculations are pretty simple when trading options. Remember, we are betting against the stock price when selling an option, and the most we can make is the premium collected from selling the option. We just want the option to expire out of the money here, in which case we would keep the $5 premium collected up front. At the same time, it makes sense for us to measure our risk reward when the trade goes on. Since we can only make $5 in this example at expiration, if I'm showing a profit of $4 well before expiration, it may make sense to close the trade. I can only make an additional $1 and I still hold all the initial risk of the position as well as the unrealized profit I see. Because we're selling the option, our break-even is better than the strike price. In this example, our break-even would be at $40. We're selling the 45 strike for $5, and we can use that premium as a buffer since it's all extrinsic value. Even if the stock price is at $40 at expiration, our option would be worth $5, but we've already collected $5 up front, so this trade would be a wash. Let's review. In all options trades, there are two sides of every transaction, the buyer and the seller side. When buying a put, we want the stock price to move down, so it's a bearish strategy. When selling a put, we're betting against the movement of the stock price, so the best case scenario is that it goes up. Extrinsic value always works in favor of the seller as it must be $0 in all options at expiration. When calculating the break-even on a put option, just take the debit from the buyer side or the credit from the seller side and subtract it from the strike price. The result is an improved break-even for the seller and a worse break-even for the buyer. Check out the written content for more information on selling puts, or proceed to the next section where we discuss buying and selling calls.